Welcome to our series Outlook 2023, and I start today with someone whom even the government listens to. I have with me Neelkanth Mishra, member of the PMEAC. Of course, today he is here as the head of equity strategy India and Asia Pacific at Credit Suisse. Neelkanth, thank you very much indeed for joining us. Well, let me start with an economy question and then go to markets and earnings. Most people have marked down the economic growth for next year around 6%, the RBI's number, mainly fearing global slowdown. What's your estimate?
Well, I think that's too conservative. I think that the economy currently is doing far better than what official data reports. I think the investors, or I would say even forecasters, are struggling with what tends to happen when you see a big break in trend. Generally, trend is a friend for forecasters, and if things are going along very steadily in one direction, it is very easy to suggest if the economy's trend growth is 6.5, whether you are at 6.7 or 6.3. If suddenly you see a break like what happened during COVID and then a sharp rebound, it is not just a challenge for forecasters. Sometimes even the NSO, the official government body, struggles to put the numbers in place. So we think that the economy is a lot closer to the pre-pandemic path than what even official data is suggesting. And the slope of the curve, which is the growth that occurs going forward, is also going to be better than what consensus is at. So we are going to slow from here. We are slowing down, but we are not slowing from, say, 7.5% to 6% or 5.8%. Which is where consensus is.
Yes.
We think we are slowing from, say, 9.5% to more like 7%.
Okay.
The time at which this data gets revised up will be too late.
Yeah.
But from the perspective of those of us in the markets, I think it's already visible in revenue growth for many of the companies.
Okay. Well, the later revisions have also been lower in previous years. But, time permitting, I'll come back to the economy. Our viewers will want to know more about earnings. The global facing sectors, like IT and all, have already seen earnings cuts. What's your estimate? FY23 itself and FY24, are we going to see big earnings cuts?
Not at all. So on earnings, I'm actually quite, as you can expect from my view on the economy as well, that we are quite positive on the 12-month forward EPS. So whatever is the 12-month forward EPS now, in December 23, it is likely to be 12 to 15% higher. Current forecast is for 15% higher number. We expect there will be some cuts. That is absolutely normal in any market, including ours. And there are, as you rightly said, many global facing sectors, IT, metals, refiners, and I think some of those can come under pressure. But on the whole, I think double-digit earnings growth is reasonably likely.
Okay, when you say double digit, you mean mid double digit, like 14, 15% for FY24?
12 to 15% is...
Fair enough. Yeah, fair enough. I mean, that's a reasonable range to work with. Now, where does this leave markets in terms of share prices? We are already seen as guilty of too high a premium compared to our own past and compared to our past vis-a-vis other Asian economies. So will that be a problem stalling indices movement in 2023?
That has been a problem for the last 15 months as well.
Yes.
Right? So in September 21, we started flagging that, look, we are very positive on the Indian economy. We think that medium-term growth looks the best I've ever seen as a top-down forecaster. And yet, my view was that the market was going to time correct. And that's exactly what it has done the last 15 months. I have a view that I think that time correction may last another 6-9 months. Now, of the three parts of the market, right, or the three parts that decide the market level, there is the 12-month forward EPS, there is the global price to earnings, and there is the India's premium. Now, so the Indian PE I've divided into two parts, global PE and India's PE premium. Now, the global PE is, it consists of the risk-free rate and the equity risk premium. So put simply, US Treasury bond yield, which is supposed to be the dollar yielding risk-free rate in the world, and what additional returns investors would want, because they're investing in an asset class which is naturally risky and volatile, which is equities. Now, both the 10-year bond yield, so the 2011 to 19 average for the US 10-year yield was in the 2.1, 2.2% range. Even though yields may fall, they are unlikely to go below 3% in the next 12 months. Secondly, the equity risk premium, given that global growth is going to be a challenge, there are geopolitical risks, ERP is also likely to rise from here. And remember, there is always a discovered number. It is never a model number, in the sense that you will see some shock on growth, you will see some shock on geopolitics, equity is correct, and that then you say, now the ERP has gone up.
Yeah.
So both are risks. Therefore, global PE has corrected, but I think we are unlikely to see it rebounding to levels that we were at 2011 to 19. PE premium has been a very large driver of India's performance in the last 12 months, the expansion in it.
Yes.
It is now at levels where, it has been higher than this only 3-4% of the time in history. Now, there are people who want to say that, look, why can't it go to all-time highs, create new highs? Now, see, in markets, we all deal with probability.
Yeah.
So nothing is impossible. We, as sensible investors, have to work around the probabilities of something happening when it has not happened for 25 years. And so my sense is that the PE premium is unlikely to expand. It may actually moderate from here.
Okay.
And if global PE is also moderate, then the 12 to 14, 15% earnings growth that I expect in the 12-month forward EPS may be the ceiling for market performance at a headline.
Okay. But what about the argument that now we have very good domestic support for earnings? I mean, even if in comparison to other countries, we are higher in terms of premium, we look too expensive. For the domestic investor who doesn't look outside and who is now migrating from bank accounts to investment products in a huge way, can that continue to keep us expensive but still rising?
Which is why I expect that the trend will be time correction instead of a very sharp decline.
Okay.
But let's put those numbers in context, right? So insurance flows are very strong. They tend to have a bit of mean reversion in them. So you would have seen insurance companies, the largest ones, were selling in September quarter last year and were buying in September quarter this year, right? So when the stock markets fall a lot, they go and buy. When they, because they have a certain weight, and if the weights change, they tend to go in the reverse direction. So they have a mean reverting trend. EPFO is, if the 20% of incremental flow decision comes through, there will be $7-8 billion a year that can come through from that. The SIPs are adding another $18-20 billion. But remember that about 50%, 52%, so more than half of the mutual fund AUM in equities is from non-SIP retail, right? So there are, and they are very sensitive. I mean, they're very sensitive to the advantages of other asset classes. So what we have started to see, as India's ERP on Indian GSEC yields has actually gone to negative territory, meaning that Indian sovereign bonds are now cheaper than Indian equities.
Okay.
Not surprising that they are starting to buy more bonds. The real estate market. So if this so this can be the counterbalancing force. So I don't expect, and frankly, I mean, whether this happens or not, frankly, expecting that the crowds will go mad is not a very sensible way to invest.
Okay. No, I take your point that it's extremely tempting if the government of India is offering 7.5% and AAA companies like a Bajaj Finance may offer 8 or 8.5. It would be very tempting and difficult for equity markets to weather that competition, and real estate is also getting attractive. But let me come to the moot question. What would you therefore bet on? Will financials continue to be the darlings because now they are reasonably expensive?
Absolutely. So what we start off this choice of sectors with is, what would the price to earnings be 1 year from now, right? So on current forecasts, and how many standard deviations above or below its 10-year average, which we call the Z score. And financials are an outlier in terms of being very cheap when you look at what the PE multiple is going to be 12 months out. On top of that, we overlay what is the risk of earnings cuts. And again, on financials, there is very little reason at this stage to be expecting earnings cuts. So I know they are a consensus buy. They have been a consensus buy for a very long time. But occasionally, you have to resist the temptation of saying something new just for the sake of saying something new, and persist with what the numbers are telling you. And I also think that the domestic economy, if there is no accident or a very tight dollar funding situation in global markets, if that happens, then there are risks to growth in India as well. But if that accident does not happen, then the probability of India growing very well is very strong. And banks and construction and cement and some of these are the best ways to play it.
Out of time, Neelkanth, thank you very much for sharing your view of 2023 and have a great one yourself. After the break, we will have the brains trust of JP Morgan, Sajid Chinoy and Sanjay Mukim join us to give us their version of Outlook 2023.